On Wednesday, the Bank of Canada is expected to cut rates again, becoming the first major central bank to go for back-to-back rate cuts in this cycle. This is mostly being priced in already, since the market is betting there's around a 90% chance of it happening. But in any case, let's think about what this would mean for the Canadian dollar and their economy. When a central bank is cutting interest rates, this will cause the currency to depreciate, meaning the value is declining. So when we look at a currency pair like the US dollar against the Canadian dollar, dollar CAD, well, we know the US Federal Reserve has chosen not to cut rates yet. So with all else being equal, if the Bank of Canada does cut rates, it will cause the Canadian dollar to depreciate against the US dollar. The resulting move in dollar CAD would be bullish, it would go up. Now, currencies ebb and flow all the time and it's not usually an issue. But when a wide interest rate differential emerges between two economies over a relatively short period of time, it can cause the exchange rate to change more severely and potentially start to become a problem. Just ask Japan. Not only will this affect the flows of capital in or out of the economy, but it will also cost businesses and consumers more to import things like services, goods, and raw materials. And businesses incurring these higher costs may actually choose to pass them on to consumers and therefore lead to higher inflation even more. Now, I'm sure the last thing that the Bank of Canada wants is for rate cuts to become the source of more inflation, and I don't think it will get to that point anyway. They'll likely pause their rate cuts at some point until the US Federal Reserve starts taking action as well, so they won't allow that differential to get too wide. But how much divergence are the Bank of Canada going to allow? Well, looking to the past for clues, it's actually not that uncommon for them to diverge. But in general, their monetary policy cycles do tend to be quite close. And as it stands right now, the divergence is at 75 basis points, which is the second biggest since 2005. So assuming another 25 basis point cut comes this week, that would put the divergence at 100 basis points. That's quite wide historically and could cause the Bank of Canada to have to slow down. While inflation and unemployment are likely to remain being the centerpiece of their meetings, this divergence could become a bigger focus for their rate cut decisions, and they'll want to avoid triggering any more inflation again. We've also got the Federal Reserve meeting coming up next week, and that may also give us some insights about what the Bank of Canada may do in future. At least if the markets think that the Federal Reserve is ready to begin cutting, it could keep the exchange rate in check, and the Bank of Canada won't need to factor that in as much. However, most major central banks seem to be taking a more cautious approach at the moment, and it wouldn't be a surprise to see the Bank of Canada also doing the same.